Welcome to the Business Finance Podcast. I have the pleasure of having Mr. Jack Callow as our guest. So if you're looking to potentially buy a business, have some opportunities which could present themselves out of a liquidation, or on the flip side, if your business has some challenges, I would stay tuned and watch this podcast because this is one that could be for you. So welcome, Jack. Thank you for joining us.
Thank you for having me. Very kind invitation. Very pleased to be here.
This podcast will be about some of the opportunities which can present themselves for people looking to buy a business out of an insolvency process. When people hear the word insolvency, to the common bear, to the uneducated, that could mean that's it, the end of the road. But you do hear some real success stories of people buying businesses out of an insolvency process. So it'd be good to hear from yourself a bit about how that works and what a potential buyer could take advantage or have some risks to be aware of as well.
Okay. Where to start? So if we go back to the word insolvency, which I think you quite rightly identify is a word that people perhaps maybe fear or certainly don't fully understand, but are attaching sort of a bad event to it. The primary focus or the primary purpose really of the insolvency regime, it's worth saying, is to help the situation. So something usually has gone wrong, and our first job as insolvency practitioners is to understand what has gone wrong and what the ultimate impact of that event or series of events is on the business and the company. In really simple terms, and people probably will be familiar with this concept, is if you have a business that can't continue, both in its current form or in a future form, it ceases altogether, and our job is to wind that company up and bring it to a close. When we look at assets and assets purchases and asset sales out of insolvency, in that event, whatever's left is usually sold for the best value it can be achieved for in a very quick time frame, because holding on to assets, security costs, insurance costs, and the rest of it, and you'll sell an asset or a group of assets, and it's an asset only transaction. What often happens, which people don't expect, is that the impact on the business which has caused the insolvency may well be, an example, a customer falls away.
Yeah.
Business wasn't expecting it, company completely taken unawares. Okay, there might be an argument that they should dilute their customer base a little bit. That's a lesson to learn for the future. But the actual underlying business is fine. Yeah. It's just had a hit that it can't work its way through. That's a far different scenario, far different set of challenges. And the reality is whilst the business cannot carry on in its corporate structure, because the underlying business is viable, there may well be something to buy beyond one asset or a chunk of assets. You're buying the business itself, and that can extend to the intellectual property, the customer base, the web design, the domain names, the operations, the know-how, the staff. And the challenges both for us, the incumbent directors, and interested parties who are hopefully have tuned in today to get a feel for this kind of stuff, is bringing it together in a very, very, very quick, short time frame, because there is no time. The reality is every day that an insolvent company continues, you're incurring costs, and a creditor might take an action which completely and utterly destroys any prospects.
I would say, picking up on what you said there, that's really, really interesting, really valuable as well, because I think a lot of people that approach us anyway, that they'll have this vision of potentially buying a business out of a process, but speed and having access to capital quickly is probably one of the main factors which determines if it's possible.
Absolutely. I mean, the process, if you will, where we believe that there is an underlying business that is viable and that this can be more, is who is going to buy it. Who is going to buy it and who's well positioned to buy it, and we usually turn to the directors. They know the business inside out. They'll know the competitors. They'll know the people that have worked with the business, and they'll know people that they've approached perhaps in the past for funding to bring in. The directors themselves might be interested. The key critical factors are: how much is it going to cost?
Yeah.
who's going to pay for it. So when we engage in such a process, we'll usually bring insolvency asset specialists on board with us. They have a huge reach in terms of getting access to people and to interested parties that deal both within the space, but within insolvency and distressed purchases generally, as well as other databases that are appropriate. That gets priced up, and effectively a marketing campaign is executed and set off underway. But as the interested parties start to build, non-disclosure agreements are required, data rooms are accessible. When it comes down to offers, or it comes down to terms proposed, it is, what's your number? How are you going to fund it? How quickly can it be available, upfront versus deferred? And ultimately, how comfortable can you get in what will prove to be a short due diligence window, working with the people that are currently in situ who you don't know, working with assets which are sold as seen. So it's risk appetite, it's capital availability.
Yeah, I mean, like we see it in our world quite a lot for certain industries anyway, more than others, where a business could be potentially bought through factoring or invoice finance. That's probably one of the most common ways people can leverage to buy a business. So yeah, no, that's really insightful. And
well, I think you might be able to educate me a little bit more on the factoring, because when you buy a business, and leaning on your finance background here, and obviously your finance role, when you buy a business, if there is a question mark over where the capital is coming from, presumably PG lending is an option. But how quickly can you start to see sort of debtor funding, factoring funding come through?
Yeah, no, that's a really good question. Yeah, I mean, factoring can be put in place as little as 48 hours. It can be done very quickly. Okay. And they could potentially fund their old company if it wasn't funded already.
Okay.
Release the capital to be able to buy the new company and make those funds available. And then when the new company starts to trade, release further funding against those future invoices as well.
Okay.
So they're funding sort of both sides of the transaction, if you like. And yeah, but they're kind of touching on the PG element as well. So yeah, if people are willing to give security, it is as well for commercial lending, that's always an option as well, through more traditional bank style loans. So they'll look at a percentage of equity that the directors have in commercial property or residential, and then they'll lend as a percentage of that. And then following on from that really is like for business owners which currently are trading, and things potentially haven't gone so well and they face some challenges. It's a tough economic climate at the moment. Everyone hears it with PAYE, NI increases, general taxes being at pretty much an all-time high. What would you say the key indicators are for a business owner to have a conversation with you earlier on, as opposed to later on when options may be a little bit more limited?
Yeah, so it is unfortunately true that the longer you leave things or the closer you get to that insolvency event, and I appreciate that not everybody will be able to foresee and things can happen very rapidly. The closer you are to the end, the fewer the options are that you have. And the reality is don't put that pressure on yourself. You should always talk to someone that you trust, and hopefully everybody has somebody they trust in the insolvency space as well as the accounting space, the lending space, and whatever spaces that there are out there in the professional services. If not, I would recommend getting one.
Yeah.
It's just having the confidence in that trusted relationship to bring that person in as soon as you've heard of it, because if it isn't ready or it isn't appropriate or there are still more options to deploy well outside the insolvency space, they will be brought to the table in that conversation. And it may well be that actually there's just some close monitoring that's required whilst the business tries to steady the ship and move through. But in terms of triggers, it depends on what KPIs you operate anyway. But if you have something along the lines of keeping 3 months worth of working capital in the bank, and all of a sudden you realise you've got 6 weeks, yes, you might go to a finance broker and go, can I have some money? And that's not necessarily a bad thing to do. But going back to your PG point, if you take the PG loan pre-event and you then ultimately end up having an event, and you might still be one of the interested parties that wants to take the business forward in new form, you might not have the option to the PG again because you've already deployed it. And so at that point, it's got to be worth a conversation just to make sure that you are making an informed decision. I mean, primarily our roles as insolvency practitioners at the pre-insolvency advisory stage, and I'm talking where there's lots of runway and we're at an early stage, is just to share the knowledge that we have. We know what the end result looks like. Coming back to buying a business out of insolvency, you are far more likely to achieve a sale out of insolvency if you're starting to talk to advisors much earlier on. It's much easier to prepare for, to understand how far you can and should go to keep in its current form. But in the back of your mind, you're saying, okay, I might need to get the best value I possibly can out of this through my fiduciary duties as director. And I know that business sale is an opportunity because I know that there is a viable business here. We're just struggling with legacy debt or whatever it might be. So that early conversation is really critical for multiple reasons. But at the same time, I don't like to send pressure out there. I just encourage conversation because the conversations will always be had.
Yeah, absolutely. And like you said, it's making an informed decision, isn't it? Because when you write options for people and they have the opportunity to ask questions, that I would have thought will relieve a lot of people's stresses and anxieties, because they're feeling at that point in time, and might give them further food for thought to actually say, oh, I could try this, I could do this, to see if that worked, and end up with a more positive outcome anyway. And on the positivity side of things, can you think of any real sort of any success stories that you've worked with clients over the years where someone's potentially had a conversation with you, maybe not gone through a process, or actually gone through a process and ended up in a better place than they started?
Well, first and foremost, I'm still quite young, Jack, so I might not have the wealth of experience in cases that I can call upon. But no, to answer your question, I've got an instruction on at the minute. Obviously, sensitive to that instruction, I won't go into details. But in a nutshell, a business was brought to me. I need a liquidation. I need to prepare for liquidation. An event had happened that was completely unforeseen. It had a litigious nature. Look, things can always be done with the benefit of hindsight better, but genuinely don't think this was the business's fault at all. The good news story about this business was its management information was very, very good. Its forecastability was very, very good. Its cash flow control was very, very good. So we were able to sit, breathe, pause, understand the position of the litigious issue. And that was in the early part of this year. And we are just tracking performance currently. And we've got to a point now where the business, having lost a huge amount of its trade, is recovering, is managing the situation absolutely as it should do, and is going in the complete opposite direction of a liquidation, which means, very importantly for people that are tuning and listening, I won't win a piece of work, but that's okay, because I will help when a liquidation is needed. If a liquidation is not needed, we will help in another way, and it works, and people should have faith in that situation. In terms of perhaps going back to a pre-packaged administration sale, so for the benefit of listeners, you can buy a business out of liquidation. You can buy a business out of administration. The difference, in simple terms, and in the interest of time, is usually around trading. A pre-packaged sale will allow you to market, identify buyer, sort legals, and basically go into administration and complete the sale immediately thereafter by the administrator. So you have the necessity of freeing the assets in the business from the company that's drowning in the liabilities. The liabilities stay behind along with the proceeds, but there's no necessity to cease trading or have a long period of time without trade, which is obviously very valuable. As soon as the doors do shut, you're on a rebuild exercise to a certain degree. In liquidation, sometimes you have to cease trade. You can't afford to pay the staff anymore. There is no money to pay, so you have to stop. But you can still pause, intellectual property might be worth something. The customer database, the collective of the business and assets might still be worth something, and there creates a bit of a breathing space, perhaps, but balanced off by the lost value of trading. But business sales can be achieved in both scenarios. A positive story. Is it a positive story? It is a positive story because I know the new business is freed of legacy debt and is doing very well. The legacy debt was a lot of VAT, which I appreciate. Certainly from a HMRC perspective, is difficult for them. If tax is crystallised, you should pay it. It's not like negotiating commercial debt. I understand that lens from HMRC, but at the same time, a proposal was put to HMRC. Okay, whether it ever would have come to fruition, HMRC have to protect reputation. It looked reasonably credible from what I could see, but they weren't prepared to entertain it beyond an unaffordable time to pay. So that created the necessity to use administration. The sale was relatively limited because other assets that were needed for trade were held in other group companies. So buyers were interested, but not all the things they needed were on the table for sale. So the party to buy was reasonably quickly identified. Consideration was real. It was proper. It was for value, and the pre-pack administration was executed. And as I say, it saved about 35 to 40 jobs, which is critical. That's Landlord was undisturbed. The lease was. A new lease was drawn up, but there are options around assignment and novation and the rest of it. And there's no loss to the local economy of that business ceasing to be anymore.
And then that concludes into the final question, bonus question. If you had £1 million, so someone gave you £1 million tomorrow, and they said you could invest this into any insolvent business that was going through a process, what would be the opportunities? What would you be looking for from that?
I don't think my wife would let me spend it, is point number one. And if in that scenario, that would be quite a position to be in, because like a lot of things in life, you only really know how to do it once you try it. It's a bit like being a dad, to be honest. I still can't believe they let you take the kid out of hospital after it's been born, knowing nothing about how to be a parent. But they do, and shock horror, you learn and you get used to it and you get better the more that you do it. Beyond that, so the first is a good opportunity could be something that you're just very familiar with. So what's your space? Asset heavy, I think, is where it still exists. If you buy a business out of administration and there are hard assets underneath it, so you might be paying a number that covers some chattel assets, could be some plant, could be some vehicles, but then you're also paying a premium on top for the business wraparound. If it all goes wrong, you have something that you can sell the other side. So a car dealership could be an example if the cars are owned as stock. Some of them are on finance. It also might give you something to leverage within the sale in terms of the other side. You could release some funding against those assets and help with working capital injection. And one of the advantages of distressed purchases is the value that you can get. You're not expected to pay market rate for this. You're expected to reflect within your offer the fact that you don't know what you're buying. In many situations, and obviously the bigger the business, the bigger the entity, the bigger the group, you'll have more information because they might have in-house finance teams and management information is being deployed all the time. But in the SME world and in the smaller end of the scale, all this stuff is a luxury. So it's certainly in practice and asset are my two go-tos.
I think there's so much value in what you said there, and I've certainly learned a lot, and hopefully you guys and gals watching as well have learned something. And I suppose I say it all the time, but the numbers are only a result of the people's actions in the business, isn't it? And having that human connection and feeling like, yes, that's someone that you can work with, or that's a team that you can work with, I think is the real driver. And if you can save jobs as well, happy days, isn't it? And keep the local economy and keep that business alive even better. So I think we could talk for hours.
I'm certainly happy to. Just trying to shut me up is the trick, but no,
yeah.
In the interest of your listeners, we're happy to wrap up.
Yeah, no, that's great, and thank you for joining us.
Pleasure.
It's been
thank
an
you
absolute,
for the invitation.
Yeah, pleasure. And if you enjoyed that, please like, share, and subscribe. And we look forward to seeing you on the next podcast.